Hi everyone, welcome to week 7. My name is Amanda Jaramillo, and today we'll be discussing the methods of taxes avoidance and reducing tax liabilities. All right, let's dive in. First, going over tax avoidance. It refers to a legal strategy used by individuals and corporations to minimize their tax liabilities. Unlike tax evasion, which is illegal, tax avoidance essentially gives you the bounds to go around the laws and taxes to ensure that you're not being taxed on the whole income, but rather, we want to look at the high income earners and corporations that use methods to pay less taxes, essentially. We'll look at how each method works and essentially how income shift, deferring income, and using deductions and credits can affect the overall taxes. All right, method 1, income shifting. So essentially, it's basically moving down a lower tax bracket that an individual or entity might want to do to essentially pay lower taxes. This is a good example of like a family business transferring ownerships or dividends to lower income members. Essentially, the way it works from what it described in chapter 24 is that parents may essentially transfer assets to their children or other relatives for in a lower tax bracket. The income generating from those assets is taxed at a lower rate based on the individual that is ownership of that tax. Essentially, this is a reduction in tax liability. It reduces the overall burden of the tax and additionally provides a little bit more revenue to the whole as far as what they're taking home in assets. Not in money, but in assets. Method 2, tax deferral. Now this is a pretty big one. Essentially, it's delaying the payment of taxes to future dates. An example of this would be a 401k or an IRA, where taxes are on contributed and deferred until their withdrawal. And so essentially the way it works, and you'll hear this a lot, especially in the public sector when it comes to income, is that you want to defer your income. Essentially, that any contributions that you make into this account will be taxable later at the time. Of course, you need to understand that when you do this, taxes essentially will be taxed at that time when you withdraw that money. So taxes today could be 22%. In 20 or 50 years, when you go to withdraw that account, taxes could be anywhere between 30 to 45%, depending on how large it is that you're taking out of the withdrawal and also what is the tax income for yourself at that time. So one way people try to clause around this is essentially withdrawing one little bit at a time rather than the whole income as a whole. Taxes are essentially paid upon distribution of the retirement when the taxpayer might be at a lower tax bracket, hopefully, but essentially the reduction in tax liability is immediately essentially while your income is going to the contributions because you're being taxed at a lower rate because your income is at a lower rate because you're deferring all your taxes to a later date and time. And chapter 24 does a really good job at understanding this dynamic because when you are contributing to a Roth IRA or an IRA, people need to understand that whatever you're doing to be taxed on at that time may be different than what it is today that you are actually contributing. So those are kind of like the two bounds that you want to think about when it comes to tax deferral. Of course, when you look at a Roth IRA, essentially you're being taxed as you go, as you contribute. So essentially when you go to withdraw, you're essentially no longer being hurt by taxes because you've been paying the whole time. And so those are certain key aspects as far as the good way about tax referrals and sometimes the bad way of tax referrals, because essentially you're always going to be taxed no matter what. It's just essentially when and how and at what time. And of course, method 3, capital gains and tax reduction. This is huge for chapter 22, and what I liked about it is that it covered essentially the deductions of mortgage interest and any other expenditures, because the way it works is that reducing the gross income through deductions, the taxable income is lowered, which leads to a smaller tax bill. And essentially the reduction in tax liability because the tax deductions are applied and then the lower tax is owed. And what it is referring to essentially is that when you own a home and you are paying into the mortgage interest, but also into the property tax, these are what are called deductions and that it can be applied at the end of the year for your annual taxes income. Because essentially, while you are paying into your mortgage and into your property tax, the value of your home will always go up because of the market prices and past structures. As far as when you look at the market as a whole, the value of your homes have going up no matter what, either whether it be by 5%, 2% each year. And yes, there are dips in the market, but overall it is still relatively going up. And so those are capital gains that you'll have later on, but it's also essentially a tax reduction because you are paying into it and the government alleviates from it because they understand that you are paying into those taxes and those interests back into the market. Another one that it went over, which was pretty interesting, is essentially capital gains treatment and postponement. And what does this mean and how does it work? Well, by deferring the sales of an asset, a taxpayer is avoiding by paying taxes and appreciated value. This delayed in taxation can reduce the effective tax rate and the gains. And so the reduction in tax liability is essentially delaying the taxation, lowers immediately, and the tax burden is ultimately eliminated. And what this means coming from chapter 2 is essentially when you are paying into certain assets that cannot be taxed, like art. Many of the higher, wealthier people pay into wealth because they're paying that sales tax, but also essentially they're not having to pay on the overall asset that they have in the artwork. But because the artwork is so valuable, essentially that is also a capital gain. And so that is some ways that essentially they have the tax reduction and certainly ultimately relieve of the tax burden as a whole because their money is tied up in that asset of artwork. So in conclusion, while legal ways that these tax avoidance and tax referrals and income shifting may essentially create disparities in tax burdens, for future tax reforms, there needs to be a balance of fairness and encourage investment. And again, not many people understand taxes as far as their reduction and when it comes to credit. I think a lot of things it's really hard to understand. Even for myself, it wasn't until I got into college when I understand that this is a tax credit and that can be applied to my annual taxes at the end of the year, and hence why I actually get a refund. Now, these are certain things that, again, that need to be advertised and essentially learned to all individuals because, again, that creates disparity when knowledge is not shared.